Hello everyone and welcome to my channel, Compliance Lookup. In this video, we will be discuss anti-money laundering and combating the financing terrorism organization in India. If you have not watched its part 1 of this chapter then, please watch first. These topics are essential for financial security and in future videos we'll dive deeper into how these procedures are implemented, the tools used, and the real-world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. Now I'm starting our first topic, the Income Tax Act 1961. Though the Income Tax Act's main role is tax collection, it plays a significant role in AML. How? By monitoring financial transactions for suspicious activities and scrutinizing high value transactions. Example: imagine someone suddenly deposits rupees 50 lakh in their account, which doesn't match their regular income. The bank must report this to the income tax department. If the individual can't explain where the money came from, tax authorities can investigate further for potential money laundering. 2. The Indian Penal Code and Code of Criminal Procedure 1973. The Indian Penal Code IPC defines crimes like fraud, cheating, and conspiracy common elements in money laundering. The Code of Criminal Procedure CAPC provides guidelines on how to investigate and prosecute these offences. Example: let's say a businessman is found guilty of fraudulently siphoning money through fake companies. Under the IPC, this would be a punishable crime. The CRPC then provides a legal pathway for law enforcement to gather evidence, arrest the accused, and take them to court. 3. The Conservation of Foreign Exchange and Prevention of Smuggling Act 1974 COFEPOSA. This law combats illegal foreign exchange transactions and smuggling, which are common ways to launder money. Example: if someone is caught smuggling gold into India without declaring it, authorities can seize the gold under COFEPOSA. This is because such smuggling is often used to convert illegal cash into goods and smuggle it across borders to avoid detection. 4. The Narcotic Drugs and Psychotropic Substances Act 1988 NDPS. Money laundering often finances illegal activities including drug trafficking. The NDPS Act deals with crimes related to narcotics and drug trafficking, and it has provisions to seize the assets gained from such activities. Example: a drug cartel in India uses laundered money to fund drug distribution. If caught, their properties and bank accounts could be frozen under the NDPS Act to prevent further illegal activity. 5. The Bename Transactions Prohibition Act 1988. Bename transactions are used to hide the true ownership of assets, often to launder money. This act prohibits such transactions. Example: if a wealthy person buys property in someone else's name benami to hide their identity and evade taxes, the property can be confiscated by the government. These hidden assets are often used to move black money. 6. The Foreign Exchange Management Act 1999 FEMA. FEMA regulates foreign exchange dealings in India, ensuring that money flowing in and out of the country is legal. It prevents illegal foreign exchanges often used for money laundering. Example: imagine a company sending large amounts of money to a foreign country without proper documentation. FEMA would allow authorities to investigate these transactions. If the money is being laundered, penalties would be imposed and the transactions could be blocked. 7. The Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. This act specifically targets Indian citizens holding undisclosed foreign assets, often as part of money laundering schemes. It enforces strict penalties for those hiding money abroad. Example: if someone has a Swiss bank account with undeclared funds, this law requires them to report it. If they fail to disclose these assets, they could face severe penalties, including fines and imprisonment. Now, coming to key points to remember. First, interconnected legal framework. These laws combined form a strong defense against money laundering. Each has its specific role but contributes to the overall goal of preventing financial crimes. Second, enforcement agencies. Agencies like the Enforcement Directorate (ED), Financial Intelligence Unit (FIO), and Reserve Bank of India (RBI) have the authority to investigate and prosecute AML offences. They work together to ensure that financial transactions in India are transparent and legitimate. Third, compliance is crucial. Banks, financial institutions, and businesses must follow these laws to avoid penalties. They must monitor transactions, report suspicious activity, and ensure their practices don't facilitate money laundering. Summary: India has set up a comprehensive system with various laws to combat money laundering, with each law targeting different aspects like foreign exchange, benami transactions, narcotics, and black money. By enforcing these laws, India ensures that illegal funds cannot be easily laundered through the financial system, protecting the economy from financial crimes. Now, coming to our next topic, legislations related to countering terrorist activities. First, the Anti-Hijacking Act 2016. This law is specifically designed to target aircraft hijacking and provide strict punishments for those involved. Its key provisions is: first, imprisonment for life or even the death penalty if a hijacking leads to fatalities. Second, hefty fines and imprisonment for attempts to hijack. Third, the law also covers hijacking attempts made outside of India if the aircraft is Indian or the perpetrator is an Indian citizen. Example: in 1999, the IC-814 hijacking involved a plane traveling from Kathmandu to Delhi being diverted to Kandahar, Afghanistan. The hijackers demanded the release of terrorists in exchange for hostages. Such incidents led India to reinforce its anti-hijacking laws to ensure swift punishment and prevention of future hijackings. 2. The Suppression of Unlawful Acts Against the Safety of Civil Aviation Act 1982. This law covers a broader range of crimes that threaten the safety of civil aviation, such as bombings, sabotage, or any threats against airplanes. Its key provisions is: stringent penalties for anyone involved in sabotage or placing bombs in airports or airplanes. Second, severe punishments for issuing threats to civil aviation or disrupting air travel in any way. Example: consider the chaos of a fake bomb threat on a flight in 2019 in India, where a passenger joked about having a bomb. Even though no bomb was found, the passenger faced criminal charges under this act because any threat to civil aviation is taken seriously under the law. 3. The Terrorist Affected Heirs Act 1984. This act is designed to provide relief and rehabilitation for people who have been directly impacted by terrorism. Its key provisions is: first, provides financial aid, medical help, and rehabilitation to the victims and their families who suffered due to terrorist activities. Example: during the Punjab insurgency in the 1980s, many families were displaced or lost loved ones due to terrorism. This act allowed for those victims to receive financial compensation and medical aid to help them rebuild their lives after such traumatic events. 4. Protection of Human Rights Act 1993. Although not specifically focused on terrorism, this law ensures that in the fight against terrorism, human rights are respected. Its key provisions is: first, establishes the National Human Rights Commission (NHRC) to monitor and investigate any human rights violations. Second, ensures that law enforcement agencies, while combating terrorism, must operate within the framework of human rights. Example: in the past, there have been instances where innocent civilians were detained in counter-terrorism operations. The NHRC can investigate such cases to ensure that innocent people are not wrongly targeted, ensuring a balance between national security and human rights. 5. The SAR Convention Act 1993. This law is part of a regional effort by SAR South Asian Association for Regional Cooperation countries to combat terrorism collectively. Its key provisions is first, it allows for cooperation between SARC nations to combat terrorism. Second, facilitates information sharing and legal cooperation for preventing and prosecuting terrorist activities across borders. Third, example, India and its neighboring SAR countries like Pakistan, Nepal, and Sri Lanka often share intelligence about terrorist groups like Lashkar-e-Taiba to prevent attacks across the region. This law makes it easier for these countries to work together on anti-terrorism efforts. 6. The Criminal Law Amendment Bill 1995. This bill introduced changes to the Indian Penal Code IPC to enhance provisions related to terrorism. Its key provisions are first, introduced new offences and increased penalties for acts of terrorism. Second, expanded the definition of terrorism to include conspiracy and abetment helping someone commit terrorism. Example, a person helping to plan or finance a terrorist attack, even if they didn't directly commit the attack, could now face the same punishment as the terrorists themselves. This change allowed law enforcement to target those involved in terrorist financing and planning. 7. Maharashtra Control of Organized Crime Act 1999 9 Buka. This law targets organized crime which often overlaps with terrorism. Its key provisions are first, special courts are set up to handle cases of organized crime. Second, faster prosecution and investigation mechanisms for dealing with terrorist related activities. Example, during the Mumbai underworld's peak, many organized crime syndicates had links to terrorism. Mukoka helped crack down on these syndicates, allowing the government to arrest and prosecute criminals faster by treating them as part of organized terrorist networks. 8. The Arunachal Pradesh Control of Organized Crime Act 2002, similar to MKOKA, but this act focuses on organized crime in Arunachal Pradesh. Its key provisions are first, special courts for faster investigation and prosecution of organized crime in Arunachal Pradesh. Second, example, terrorist groups that operate across India's northeastern borders often engage in smuggling, human trafficking, or drug trade. This law provides the framework to target such criminal activities which are closely linked to terrorism in that region. Conclusion and important note. While these laws form the legal backbone against terrorism and threats to civil aviation, they need to be implemented properly for them to be effective. Other important laws like the Unlawful Activities Prevention Act UPA also play a significant role. It's crucial to maintain a balance between national security and human rights so that counter-terrorism measures don't infringe on civil liberties. Now coming to our sixth topic, RBI Guidelines 1. The Prevention of Money Laundering Act PMLA 2002 and RBI guidelines form the backbone of India's efforts to combat money laundering and terrorist financing. Let's break down each section to understand how these work in practice. 1. Authority of regulator under PMLA Section 2FA. Section 2FA of the PMLA 2002 defines what a reporting entity is. These are entities that must report suspicious financial activities to the Financial Intelligence Unit India FIOINT. This includes banks, financial institutions, intermediaries like stockbrokers, chit fund companies, and others involved in financial activities. RBI as a regulator, the Reserve Bank of India RBI has been designated as a regulator for these entities. This means that the RBI is responsible for ensuring that these institutions follow PMLA provisions and MLCFT measures. What does the RBI do as a regulator? First, issuing guidelines. RBI provides detailed instructions to banks and financial institutions on how to prevent money laundering and identify suspicious activities. Second, monitoring compliance. RBI keeps a close watch to ensure that these entities are implementing MLCFT measures properly. Second, taking action. If a bank fails to follow the rules, RBI can take corrective actions, impose fines, or even restrict its operations until it complies. Example: if a bank fails to report suspicious transactions despite knowing about large, unexplained transfers into a customer's account, RBI can penalize the bank for failing to follow the reporting norms under the PMLA. 2. RBI guidelines on AML CFT compliance. RBI's guidelines serve as a roadmap for financial institutions to ensure that they aren't used for money laundering or terrorist financing. Let's go over the major areas covered by these guidelines. A. Know your customer KYC norms. KYC norms are designed to help financial institutions identify who their customers are so that they don't allow illegal entities or persons to open accounts and use them for laundering money. What it involves: first, customer identification. Banks must verify the identity of their customers using official documents like Aadhaar, PAN card, etc. Second, risk-based approach. Banks should do enhanced due diligence for high-risk customers like politically exposed persons, PEPs, or individuals from high-risk countries. Example: when you open a bank account, the bank asks for your Aadhaar card, PAN card, and other identity proofs. This is not just for record keeping, it's also to ensure that they know who you are and can monitor if any suspicious activities happen in your account later. B. Customer Acceptance Policy CAP. CAP ensures that banks have a process in place to decide whether to establish a relationship with the customer or reject it based on risk factors. Banks assess the risk of each customer before allowing them to open an account. Higher risk customers might require more scrutiny or might even be rejected. Example: if a person is involved in several high value international transactions with unclear sources of funds, the bank may classify them as high risk and either reject their account application or monitor their transactions more closely. C. Transaction monitoring. Banks must monitor customer transactions to detect and report suspicious activities that might indicate money laundering. How it works: first, banks set thresholds for large transactions, e.g., above rupees 10 lakh. Second, use of automated systems to monitor accounts for suspicious behavior. Third, transactions involving cross border funds, cash deposits, or high value transfers are flagged for further investigation. Example: if someone suddenly deposits Rs 1 crore into their account and transfers it abroad without a clear reason, the bank system will flag this transaction as suspicious. The bank is required to report this to the FUENT. D. Record keeping. To ensure transparency, banks must keep detailed records of their customers' identity and transactions. What it involves: first, records of all transactions for at least 5 years. Second, maintaining accurate customer information, which should be updated regularly. Third, ensuring data security to protect customer confidentiality. Example: a bank must keep detailed records of all high value transactions made by a business account for several years. If law enforcement needs to investigate the business later, these records will be crucial in understanding the business financial activities. E. Internal controls. Banks must establish internal procedures to prevent and detect money laundering. What it involves: first, setting up compliance teams that ensure all AML measures are followed. Second, regular audits to check if the bank's AML measures are effective. Third, reporting any non compliance immediately and taking corrective actions. Example: a bank's compliance department must regularly check if all branches are following AML rules and report any issues. If one branch fails to identify a suspicious transaction, the compliance team will audit and correct the problem. F. Employee training. Employees must be trained on the risks of money laundering and their role in preventing it. What it involves: first, regular training sessions for staff on how to spot suspicious activities. Second, Awareness programs to ensure employees understand the legal consequences of not complying with AML rules. Example: frontline employees like tellers receive training on how to recognize when a customer might be involved in laundering money, such as through frequent large cash deposits without a clear source. Key points to remember. First, the RBI's role as a regulator is crucial in ensuring that banks and financial institutions don't become tools for money launderers. Second, non compliance with RBI guidelines can result in penalties, legal action, or even loss of business license. Third, these guidelines are regularly updated to keep up with evolving risks and international standards. Example of consequences. In 2018, RBI fined several banks for not following KYC norms, including failing to report suspicious transactions. These fines serve as a warning to all financial institutions to take MLCFT compliance seriously. Coming to its conclusion, the PMLA and RBI guidelines ensure that financial institutions in India are fully equipped to detect, prevent, and report any attempts to use their services for illegal activities. By following these guidelines, banks protect themselves from penalties and ensure that they are contributing to the global fight against money laundering and terrorist financing. Now, coming to our seventh topic, the International Bar Association IBA guidelines. These are essential frameworks designed to ensure fairness, transparency, and professionalism in international arbitration. Let's break down each of the guidelines with real world examples to understand their relevance. Let's understand in brief. 1. IBA Guidelines on Conflicts of Interest in International Arbitration 2024. These guidelines help identify and resolve conflicts of interest that arbitrators might have in international arbitration. The main goal is to ensure that arbitrators are impartial and independent to maintain fairness in the process. Key points first. Impartiality and independence. Arbitrators must be free from bias, meaning they shouldn't have any financial or personal relationship with the parties involved in the case. Second, expanded disclosure obligations. The 2024 update requires arbitrators and parties to disclose more information upfront to identify potential conflicts. This includes past professional relationships, financial interests, or family ties. Third, stricter standards. The new guidelines also set stricter standards for what constitutes a conflict of interest. Even the appearance of bias can lead to an arbitrator being disqualified. Example: imagine there is a dispute between a multinational corporation company A and a state owned company from another country company B. The appointed arbitrator had previously worked as a legal advisor for company A's affiliate 5 years ago. Under the ABA guidelines, this would need to be disclosed because it may raise questions about the arbitrator's impartiality. Even though the arbitrator no longer works with company A, the guidelines ensure that any potential bias is brought to light early in the process. 2. IBA guidelines on party representation in international arbitration. These guidelines set the ethical standards for how lawyers and representatives of the parties should conduct themselves during arbitration proceedings. The aim is to maintain integrity and fairness throughout the process. Now, coming to its key points. First, professionalism. Lawyers must act professionally and ensure that they represent their clients without engaging in unethical practices. Second, fairness. The guidelines emphasize that all parties should be treated equally, and the lawyers should not take advantage of loopholes or try to mislead the tribunal. Third, integrity. Lawyers are expected to uphold the integrity of the arbitration process by not presenting false evidence or making frivolous claims. Example: consider a scenario where a lawyer representing a company in an international arbitration case discovers that one of their key witnesses has fabricated evidence. Under the IBA guidelines, the lawyer is obligated to withdraw that evidence even if it weakens their client's case. These guidelines prevent lawyers from using dishonest tactics to win arbitration cases. 3. EBA rules for investor state mediation. These rules are designed to provide a clear framework for mediation in disputes between investors and states. Mediation, unlike arbitration, is a non binding process where both parties try to reach a mutual agreement with the help of a neutral mediator. Its key points. First, efficient mediation process. The rules ensure that the mediation process is smooth and timely. The mediator helps both the investor and the state to negotiate and find a resolution that works for both parties. Second, fairness. The rules aim to ensure that neither party has an unfair advantage during mediation, maintaining balance between the investor and the state. Third, mutually acceptable solutions. Mediation is voluntary, and the goal is to reach an agreement that both the state and the investor find acceptable. Example: suppose a foreign company invests in a large infrastructure project in a developing country. Due to changes in government policy, the project is stalled and the company suffers financial losses. Instead of going through a lengthy arbitration process, both the company and the state may decide to enter mediation under the EBA rules. A mediator would then help them negotiate, perhaps leading to a settlement agreement where the government offers compensation or alternative project opportunities. Importance of EBA guidelines. These EBA guidelines are widely used in the field of international arbitration because they first set global standards. They provide a common framework recognized worldwide, ensuring consistency in arbitration proceedings. Second, ensure transparency and fairness. By following these guidelines, arbitrators and lawyers contribute to a fair and transparent process, building trust in the system. Third, help resolve conflicts efficiently in investor state disputes. The EBA mediation rules can lead to faster resolutions benefiting both parties without needing a long arbitration or court process. Coming to its conclusion, the EBA guidelines are invaluable in maintaining the integrity and fairness of international arbitration proceedings. Whether ensuring that arbitrators are impartial, that lawyers act with professionalism, or that investor state disputes are mediated fairly, these guidelines provide a clear framework for resolving complex international disputes. Now, coming to our eighth and last topic of this chapter, some enforcement cases of PMLA. Some key aspects of PMLA enforcement. 1. Prosecution. After the investigation, the ED files charge sheets before a designated PMLA court. These special courts have the authority to hear money laundering cases. The ED presents the evidence to the court aiming to prove that the assets were indeed obtained through illegal means. 2. Conviction. If the court finds the evidence sufficient, it can convict the accused. The penalty for money laundering under PMLA includes imprisonment up to 7 years or more in some cases and confiscation of illicit assets. Convictions act as a deterrent to potential criminals involved in money laundering. Notable conviction cases under PMLA. Let's look at some high profile cases under PMLA to understand how the law is applied. A. Rose Valley laundering case. The Rose Valley Group, a major conglomerate, was involved in running a Ponzi scheme, deceiving thousands of investors by promising high returns. It is estimated that the group collected over Rs 17,000 crore through fraudulent means. The ED investigated the group's activities under PMLA, tracing the money laundered through various accounts. The group was found to have invested the funds in luxury properties and sent large sums abroad. The ED attached properties worth hundreds of crores and arrested several key individuals, including the chairman of Rose Valley. They were convicted and sentenced, and the company's ill gotten wealth was confiscated. B. Galaxy Impex money laundering case. Galaxy Impex, a company dealing in diamonds, was accused of inflating the prices of imported goods and using fake bills to move money out of India through ALA transactions. The ED found that Galaxy Impex laundered around Rs 150 crore by manipulating trade prices and transferring money illegally abroad. The ED froze several assets, including bank accounts and properties, linked to the fraudulent activities. The promoters of the company were convicted and their assets were seized. C. Drug related money laundering case. Money laundering is often linked to drug trafficking as drug cartels use the proceeds to fund their activities or invest in legitimate businesses. The ED traced the financial trails of drug traffickers and discovered that the profits were being laundered into luxury real estate and other businesses. The proceeds from drug sales were disguised as legitimate investments. Several individuals involved in drug trafficking were arrested. Their illicit properties, worth hundreds of crores, were seized. The conviction sent a strong message to drug syndicates about the consequences of money laundering. D. Hari Narayan Raj money laundering case. Hari Narayan Raj, a prominent businessman, was accused of amassing wealth disproportionate to his known sources of income. The aide alleged that he was involved in large scale financial irregularities and used illicit funds to acquire assets. Investigations revealed that Raj was involved in shell company transactions and Benami proxy transactions to hide the true ownership of the assets. Raj was arrested and his properties, including real estate and luxury cars, were attached. He was convicted and sentenced to prison for laundering proceeds of corruption. E. Lashkar-e-Taiba terrorist money laundering case. This terrorist organization used money laundering to finance its terror activities primarily through Hawala networks and shell companies. The aid, in collaboration with other agencies, traced the flow of funds being sent to India to fund terrorist operations. These funds were disguised as business investments and funneled through illegal channels. Several operatives were arrested and their assets were frozen. The aid dismantled a significant part of the money laundering network that supported terrorism. The convictions helped curb the funding of terrorist activities. Now, coming to its conclusion, the Prevention of Money Laundering Act (PMLA) plays a critical role in fighting financial crimes and protecting the economy. Through the dedicated efforts of the Enforcement Directorate (ED), India has successfully prosecuted many high-profile cases, resulting in convictions and asset seizures. These actions send a strong message about the consequences of money laundering, whether linked to corporate fraud, drug trafficking, or terrorism. The PMLA ensures that those who try to legitimize illicit wealth are held accountable, protecting the financial system from misuse. So, we have completed this chapter of anti money laundering and combating financial terrorism legislation in India. In the next, Chapter 7, we will learn about anti money laundering and combating financial terrorism organization structure in India. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.